Good afternoon. Thank you for taking some time out of your afternoon to join us today. What's been a pretty exciting start to the year, not just because they're positive in portfolios, but there's just been no shortage of news. And I got to be honest, this is probably one of the first quarters I really struggled with what I wanted to focus on in this in my commentary. There was just so much to cover. And I decided to leave a few things alone. I'm not going to talk about the banking issues. I think everybody's probably sick of that. I'm happy to answer questions on it, share my thoughts and opinions. We've certainly done a lot of research on that, including on portfolios to make sure our exposure to those banks that are at risk in particular was zero, which good news it was. Also to make sure that our exposure to regionals was minimal, which was about 1%, and that our exposure to overall banks, which was around, I think it was 4%, 4.5%, was kept at a minimum. And the good news is that we were able to get through that pretty volatile period for the banking industry. And there's probably still more to come there, but we were able to get through that pretty carefully. The other, I'm not going to take too much time on recession. I think it's becoming more and more clear that we probably will hit a recession. And it depends on what you choose to read, whether that's going to be a significant recession or a very minor recession. It seems that the majority of analysts out there feel that it's going to be a pretty shallow recession. I've got my fingers crossed that it will be, and the saving grace is going to be wages and unemployment continuing to be pretty strong. We should see those unemployment numbers tick up. It will be a very much a unique recession if that does not happen. Let me come back to the beginning here for a moment. I just again want to mention this is our 25th anniversary. I pinch myself just thinking, how could it possibly be 25 years already? And we certainly could not be where we are today without all of you fine people. And thank you from the bottom of our hearts. We truly appreciate it. And there's certainly a lot to be grateful for, having been able to do this for 25 years. It's a great career. It's a wonderful industry. And I could see putting another 25 years in as well. That's how much I enjoy it. And the good news is I have a great team around me who enjoys it just as much, if not more than me, every day. All right, with that, let's jump into it. Again, there's just no shortage of news for the first quarter of 2023. It just gave us so much to talk about. And as I was saying, it was that difficult to narrow it down for today's discussion. And what I realized in preparing was that we should do as we always do and just stay focused on the long term. When I mention this to a lot of people in retirement, their response is often the same, and that is that we do not have a long time period as we're retired, and our time period is a lot shorter than most. And my response without hesitation is consistently that no matter what stage you are in life, you still have a long-term time horizon. The reason is that we need to not only have our portfolio provide for today, but we also need for it to provide for tomorrow. The money needed in the short term, which we define as the next 2 years or less, is intentionally allocated in a conservative manner, with the funds in cash or being added to cash by way of dividends or interest being directed to the cash, as opposed to being reinvested into the portfolio. During your accumulation phase, we do reinvest that. That automatically goes right back into your portfolio in most cases, and just continues to grow. Let's start with a brief discussion on how we manage money as you approach retirement and into retirement. And this also could be said of a major purchase. So you may not be approaching retirement, but it could be a major purchase that you're facing, such as a new home or a second home or education for your children, etc. Every one of you has seen this slide in the past, and some of you are pretty familiar with it because it's presented regularly for those who are within 2 years of retirement or later. During our accumulation years, the years that we're saving, the approach is a lot different, yet we continue to diversify and maintain most of our assets in the blue and yellow sections of this design here, or of this model. We reinvest those dividends and interest that you can see on either side of this diagram. And as we approach retirement, the model begins to shift. Right? Our income streams come to an end. That would be our earned income. And we're now dependent on our portfolios and Social Security, and for some lucky souls, a nice pension as well. Given that our portfolios will provide the bulk of our annual need for most of us, we have to be very clear on what your level of spending is so that we can properly build your portfolio to support those withdrawal needs. We never want to put at risk your spending needs. By managing your money so that at all times 2 years of withdrawals are without volatility, that money must be maintained in cash, or what we refer to as identifiable cash, those interest and dividends. Cash or money markets have given us little result in the last 15 years, but one of the benefits of seeing these increased interest rates is we're now in an environment where short-term rates are actually higher than long-term interest rates, and we can finally make some money with your cash. That's been a long time since, right? And most of you certainly recognize this because the bank accounts that you've got your money in have given you little or nothing. And interesting enough, bank accounts have certainly lagged those increasing interest rates, and most of them are paying less than 10% of what rates are at today. Now, as a result of our efforts on the portfolio, we've become very active in the money market research effort, and we're consistently looking for the best options to make money on that cash position. One more thing that I want to point out, when we review your account and show the performance and it is negative, like all of us in 2022, it's pretty easy to interpret that as your entire portfolio being down. But what is really important to note is that the volatility on the upside and the downside is really being captured in that yellow section of your portfolio, which is earmarked for 7 years and longer, or better known, of course, as the long term. This is important as we focus on volatility. I look forward to discussing this more specifically in detail with any one of you who have any questions on your portfolio specifically. I usually will reference this piece for folks who are within 2 years of retirement, or for relatively new clients, you might have seen this in the planning phase for financial independence. Well, another aspect of approaching retirement is the concern for bottom line performance. When you are in retirement or close to retirement, no longer are we swinging for doubles, triples, home runs, or even grand slams. It's of great importance that we swing for singles and the occasional double. When we swing for the fences, we not only experience more volatility, but we also recognize that volatility is the enemy of any retirement portfolio management approach. I came across this piece a few years ago, and I held on to it for good reason. This demonstrates two investors. Both of them clearly started with $100,000, and they're also both allocated exactly the same, 60% stock and 40% bond. And they're each taking exactly 5% or $5,000 out of the portfolio each year. The time periods are real, but they are different starting points, with Mr. Smith starting in 1969 and Ms. Jones starting in 1979, the respective year in which they turned age 65. Over the course of their investment time horizon, Mr. Jones had a much better annualized return at 10.5% versus Ms. Jones, who had an average rate of return of 9.6%. However, the volatility of those returns certainly mattered, as Mr. Smith completely ran out of money 20 years into retirement. Same withdrawals, same level of risk in the portfolio. Ms. Jones experienced less volatility, and as a result, still has her portfolio intact about 30 years later, albeit with nearly 6 times her original deposit, even after withdrawals. What we're seeing here is the importance of not only volatility, but also the order of returns. Mr. Smith experienced some negative returns early in his retirement, while Ms. Jones did not. Since we do not know what the future holds and what those order of returns will be, we must be attentive to how your funds are managed for retirement or any other major purchase, including children's education, a new home, or a second home. All right, let's turn to the current market environment. And I've got to admit, there's really very little that's exciting about the current US market environment, as we see valuations climbing to almost 18 times earnings, which I've highlighted down on the right-hand side there. That takes us back to above the 25-year average. And if you remember the last quarterly commentary in January, we were still below the 25-year average. Now, that simply means that US stocks, as measured by the S&P 500, are by no means considered cheap versus the last 25 years that we've experienced. Looking at the information the box captures above the chart, there are actually several areas of the S&P 500 that are less attractive than their 25-year averages, including the price earnings ratio that we were looking at, the Cape-Shiller, dividend yield, price to book, price to cash flow, earnings yield minus the BAA bond yield. All of those are less attractive than the 25-year average. Now, we cannot make a decision based on this analysis alone, which is why we have not and will not sell out of the US markets entirely. Although we wish we did back in the early 2000s, the decision to sell really requires two nearly impossible decisions. One, when to sell, and two, when to get back in. Although we are confident in our abilities as money managers, we have no confidence in our ability or the ability of others to make those two impossible decisions. Now, when we dive deeper into the US markets, we do find some windows of opportunity. However, the year-to-date numbers are less than representative of the opportunity, even though 2022 made very clear the benefits of value investing in this market environment. As most of you know by now, last year we saw domestic value stocks substantially outpace growth stocks by a factor of nearly 4-to-1, with a 7.5% return for value, a negative 7.5% return for value versus a negative 29.1% return for growth. This year, we started with an incredible run for growth stocks in January. That pace did slow dramatically, but still giving growth a strong quarter, with a result of a 14.4% return for growth versus a 1% return for value. Our belief is that it will be short-lived given the overall investment environment. Warren Buffett's mentor, Benjamin Graham, said it best. In the short term, the stock market is a voting machine, but in the long term, it is a weighing machine. The phrase simply means that while short-term price movements can be volatile and influenced by a variety of factors, such as news events, sentiment, and investor psychology, in the long run, the market tends to reflect the true value of a company based on its underlying financial and operational performance. Considering this is the long-term portion of your portfolio that you have exposure to these stocks, we do not want to be influenced by the short-term headwinds. Here's a closer look at the numbers. In the top center, I've circled the numbers I referenced in my comments a moment ago, with the performance of growth and value year to date, 14.4 versus 1.1. Now, if you look immediately below that chart, we see a longer time period dating back to 2020 in March. Here we can see the slight outperformance of value versus growth and the more remarkable outperformance of small cap value at 104.8 versus small cap growth at 67.2. On the very bottom right, we see the voting machine at work, with the most substantially overvalued part of the market clearly being that which has the highest recent market performance. And that's the large cap growth exposure, being 127.5% of the 20-year price to earnings ratio. Also of note is the undervaluation of small caps, both value and growth being undervalued, 89.9% for growth and 92.8% for small value. One might think that with the undervaluation of small caps versus the 20-year average, that we would be inclined to overweight the small caps in your portfolio. But as you could imagine, that very well could be a mistake. First, small cap stocks of either flavor, value or growth, are notoriously more volatile. In addition, small cap stocks in general have a much higher probability of not being profitable. As a matter of fact, nearly 42% of today's Russell 2000 companies are not profitable. That number has been on the increase for at least 25 years. And if you just take a look at the chart on the top right, here you can see the percentage of Russell 2000 companies that have not been profitable going back to 1998. And you can see they're clearly on the incline. Couple that with the interest rate coverage ratio of only 2.6 times, and we think it's easy to understand why we tread lightly here. And that's the bottom here. You can see the interest rate coverage ratio for large caps is at about 9.8, and the interest rate coverage ratio for small caps is at a mere 2.6, which is in line with the average, historical average, but that's still a pretty thin coverage ability. Interest rate coverage is their ability to cover the cost of the debt that they have on Next, you did see this slide. It's updated, so it's more current, but you did see this slide as well as the one that follows in our last commentary. But international has been quite attractive for a lot of reasons, and we may very well be in for a period of time where we see international outperformance like we did from the year 2000 until 2008. We had a very, very long run of outperformance in the US markets versus international, lasting about 14 years and delivering a whopping 277% return. One of the most common mistakes that we see in investing, as well as in other areas of life, is what is referred to as recency bias. This can be explained as giving more relevance to what happened recently and ignoring the actual data. This bias, like any, can influence our judgment and our decision-making. Placing too much emphasis in your portfolio on recent market trends could lead to a disaster, as it did for many people back in the year 2000, when they overweighted to large cap growth and got completely decimated for 3 years following. Again, we visit on this in our last commentary as well, but it's updated for the first quarter, and it is still quite evident that international markets present with a lot more opportunity than US markets. We have seen very favorable results year to date in our international exposure, and you can see that by looking at your recent statements, how strong Artisan and Morgan Stanley have been in your portfolio. We are pretty excited about what the future holds here. Time will certainly tell, but all indications are that we should see a pretty strong international market. All right, let's make a shift and talk about housing for a moment. We see a potential housing crisis on the horizon. On the bottom of this page, we find that rental vacancy rates are actually quite low. And on the right, the increase in multifamily housing starts has really taken off to a level that we actually haven't seen since the 1980s. Now, in my opinion, under normal circumstances, this could be cause for great concern. However, the single family housing issues may allow for the multifamily boom to continue, as well as lead to a very soft landing for single family home values. And in some areas, in this area in particular, we're already starting to see housing prices increase again. At the top left, we see that inventories for single family homes are very low. And then you couple that with the below average new starts on the right-hand side, and the indication is that we may continue to see a shortage in the single family housing market for some time. Many predictions are that we're behind by about 1.2 million units in the United States. Rental rates have softened recently, but vacancies remain very attractive. And if you take a close look, you'll see they're about 20% below the average since 1956. So I don't see a significant housing crisis in general. Some areas may experience a worse than average housing situation, but there will be a lot of areas, including upstate New York, that will most likely experience a very, very good housing market going forward. Next, so this is probably a little bit more of a concerning slide, but the good news coming out of this is that the consumer continues to spend. And to have a good economy, we obviously need high consumption. People need to spend. As evidenced by this chart, the amount of personal savings has fallen sharply from the all-time high back in 2020. And that would be this number here. We're now at 4.5% savings. The average going all the way back to 1960 is 8.9%. So we're roughly 50% of the average savings rate. On the top right, we see the outstanding credit, and that continues to climb. But the very bottom here on the bottom right shows that the pace of wage increases has helped keep the percentage of disposable income used for serving that debt at a pretty modest 6.2%. Over time, something does have to give. And naturally, my hope is that people will start to save for their futures. But the health of the economy is dependent on that consumption. It's a two-edged sword, folks. Saving more means spending less, and spending less means a weaker market. As always, time will give us the answer. All right. I only want to spend a moment on inflation, and most of you certainly know that inflation is starting to improve. I just want to say we're fortunate enough to avoid the heavy inflationary pressures that were experienced back in the 70s and 80s. And the Fed increasing interest rates really can be thanked for helping us through the significant harm that would have been caused for every one of us. Many people are surprised to learn that the 50-year average inflation rate is 4%. In your planning, we use 3.25% because that's pretty close to the 100-year average of 3.1. Now, the last couple of decades, it's been closer to 2%. We're currently at 6%, and that's obviously down quite a bit from the near 9% reading that we saw late last year. More than likely, inflation will continue to tame, and within the next year or two, expectations are that we will find ourselves back in the 3% range. So, of course, the tool that the Fed uses to help control inflation is obviously interest rate. What we experienced in 2022 was actually a record-setting interest rate increase over the course of a year. Now, as the Fed increases rates, clearly its intent is to tighten money supply. This has been anything but a normal market cycle, as we saw rates climb faster than they ever have, yet wage growth and unemployment never flinched, with unemployment actually falling to below 3.5%. Looking forward, the Fed will not keep rates as high as they are. Once the economy begins to cool, the Fed will start to reduce rates, and the cost for borrowing will go down. We do not expect to see interest rates anywhere near where they were a few years ago. More than likely, mortgages will fall to the 4 to 5% range, as opposed to the 2 to 3% range that we saw in 2020 and 2021. Looking at the impact on money supply, we can see how dramatic those interest rate increases really have been. This chart dates back to 1960, and what we can clearly see is how significant the impact has been with these wild gyrations on the far right-hand side. But this chart also demonstrates that the Fed cannot hold rates as high as they are for a prolonged period without causing significant damage to the economy. Hence, the expectation is that lowering rates are not too far into the future, more than likely happening in late 2023 or in early 2024. Now, 2022 was a record year for interest rate hikes, but 2023 will also be a year for the record books. With the banking crisis that hit us a handful of weeks ago, the Fed actually opened its emergency lending, and if you can believe it, banks drew more than they ever have in history, including during the banking crisis in 08 and 09. Although more funds were borrowed during this banking crisis, that should not be interpreted as a concern level that is anywhere near that of what occurred in 2008 or 2009 during the Great Financial Crisis. As a matter of fact, the most recent earnings reports that we've seen in the last few weeks from big banks have exceeded expectations. And this can certainly not be said of the banks 15 years ago. I know this is a bit off in terms of timing, but as a big college basketball fan, I couldn't help but share a fun comic that I came across a few weeks back. Many folks were concerned that we would see a collapse of the banking system, especially regional banks. And the result would be a significant number of mergers in the banking industry. My guess is that we will see some additional consolidation, but we will move forward with a large number of banks to choose from for our own banking needs. And for those of you not familiar with it, they were talking about, is this the race for the Final Four in basketball? And the question, of course, is, was that basketball or banks? Or are we going to end up with only 4 banks? Cute piece. It's important to take a global look at the environment for central banks to gain a perspective on other economies and what they're experiencing. And as you can see, nearly every country on the list has increased rates in 2023. Turkey being the only exception for 2023, as they made a rate cut. I'm not going to speak of the economic conditions in Turkey. Just know that things are pretty horrific there. Japan's last rate action was in 2016, while China and Russia both made rate cuts in 2022. The fourth column that I've circled here is the year-over-year CPI rate, better known as the inflation rate in each of these countries. And you can see that it's quite a range, but the majority fall between 3.5% and 9%. The central bank rate in the US happens to fall near the middle when ranked against each of these countries. And I can truly say that I feel blessed to be a citizen of the United States in these times. If you take a close look at some of these, you'll see how outrageous they are. Look at Argentina, 102%, Turkey, 55%. Focusing a little bit more on the inflation rates themselves in the various countries for another moment, we can see that we have a good mix of countries that are seeing declining inflation and some who are experiencing higher inflation. Continuing to focus on the US, it is refreshing to see that we are in the lower half of inflation rates across the globe, as painful as it has been for most of us. Let's turn back to what's going on with the yield curve. Currently, the 10-year Treasury yield is actually lower than the 3-month yield by the widest margin since at least the 1960s, if not in history. And if you think about that for a moment, that means that we have obviously an inverted yield curve, but a more significantly inverted than we've had since the 1960s, when a 10-year bond, a 10-year Treasury, is paying you less than a 3-month. As a matter of fact, you are better off owning a 3-month Treasury than a 10-year Treasury by 1.67% just a few months ago. As this became a reality towards the end of 2022, we made a significant change in the money market in your portfolio by allocating to the Fidelity 3-month Treasury money market, which is currently yielding about 5%. This will not last as we see interest rates start to fall and the yield curve return to normal. While it is rewarding us for short-term money, we certainly want to take advantage of that in your portfolio. As we come to a close, these last few slides give us a snapshot of history. The first slide here looks at the years in which the previous calendar year was negative, and the first quarter of the year following that negative year was positive. So what we just experienced, a negative 2022 and a positive first quarter to the year following. Since World War II, this has actually happened 10 times. And the good news is that in every one of those 10 occurrences, the entire year finished in the positive. And if you look at what I circled here, which are those years, some of those are pretty darn attractive years, right? 33%, 31, double digits, 12, 23, 11, etc. Another look reflects on negative market years in which there was a midterm election. There have been 9 such occurrences, including the year 2022. And the good news is that, just like on the previous slide, every year that followed was positive. The even better news is that the average return was actually over 24% in the following year. Now, to be perfectly honest, I do not expect that 2023 will give us a 24% return, but I do think we'd all be pretty happy with a high single digit or a low double digit result. And I think that's where we need to set our marks. I think we'll be pretty fortunate to find ourselves in the high double digits or low double digits, high single digits for the year. Finally, our success and our satisfaction in life really comes down to focusing on the things that we can control. I found this piece to capture that thought pretty well. Give me coffee to change the things I can, and wine to accept those that I cannot. If we spend all of our time and effort focusing on the things that are not in our control or influence, then we are destined for failure or for a glass of wine far too frequently. Our efforts at Custom Wealth Management will always be focused on the areas that we can control, while paying attention closely to the weighing machine and far less attention to the voting machine that I mentioned at the beginning of today's discussion. As always, I want to thank you for taking time out of your day to join us, and thank you for the trust and confidence that you put in our team as we work diligently to help you meet your financial goals. I want to finish this last slide, just introducing to you 3 new additions to our incredible team at Custom Wealth Management. Introducing you to Julia, Lucas, and Tracy. Many of you have heard from Tracy by email or by phone. She is my right arm in terms of coordinating meetings and helping me to manage my calendar. Julia works closely with Perry and Sam in the client relationship manager role, doing planning and putting together our presentations for you. And Lucas is focused on our 401k, the 401k part of our business. Please give them a warm welcome if you happen to meet them by phone, by email, or in person. And they've been with us a couple months now, and it's been a very fun experience bringing them on board. And then finally, if you haven't already, please take a moment to follow us on the various social media things out there. I don't know much about these things, but apparently they're important in today's world. And now I'd like to open this up for questions or comments or anything that any of you would like to add. If you look on your screen, you should be able to find pretty easily the mute button. Feel free to click on that and ask any questions you might have, or if you're more comfortable doing so, feel free to private message me on the chat bar down right on the Zoom meeting as well.
So you mentioned that small caps are less profitable over time. So in an impending recession, are they going to suffer even more? And then the second question I have is, so we didn't talk about tech, and for the last decade or so, tech was really driving the S&P 500. Is that still the case?
Sure. So tech, I think it's fair to classify as being part of your large cap growth bucket, which would be any of your growth buckets. So that would be this column here and this column here. So large cap growth, large technology companies fit into that arena. So you could place companies like Amazon and so on here. Those are significantly overvalued. And even with the downturn that they've had last year, they're still pretty significantly overvalued. On the small cap side, 42% of those companies do not make a profit. However, that does not always interpret to performance, right? So we may see an improvement in performance of small cap over large cap because of these valuations here. And what I'm getting at is we do not have a typical situation where certain asset classes are substantially overvalued as a result of what happened in the market. Domestically, we are fair value or overvalued versus internationally being pretty substantially undervalued. Other questions or comments or thoughts?
Just following on Frank's comment, I write about business for my living. And, one of the things about the tech companies is that they've laid off hundreds of thousands of people since the beginning of the year.
Mm-hmm.
Yes.
So I'm not sure how that's playing into their valuation or your attitude toward them or whatever, but that's been a big, big topic for me since January.
And Maria, you're probably familiar with this. One of the things that seems to be fairly commonly understood is that the tech companies overhired to store away talent that they thought they might need. And now that what we're seeing is the result you just mentioned, laying off tens of thousands, hundreds of thousands of people.
Mm-hmm. Yeah. Also, I've also been writing about the gig economy this year.
Yeah.
And the finding is that the tech freelancers are making more than any other freelancers. Some of them make millions of dollars a year.
Yes.
And I believe some of those companies actually hire people as freelancers too.
They certainly do.
Yeah, so it's pretty. I see it as a pretty volatile part of the market right now. But you may have different feeling of it. From an investor perspective.
Sure. Traveling nurses too, by the way, it's unbelievable. Traveling nurses are making 300 to 500,000, most of them.
Thank you both for the answer. I was just kind of wondering, for John, what was the acronym for the four tech companies that drove everything? And maybe that if we're going through a little bit of a transition time where there could actually be greater diversity to our benefit in the tech market.
Sure, that was FAANG, F-A-A-N-G. That's been replaced, according to our friend Jim Cramer, with MAMA, M-A-M-A-A. Meta, which is the old Facebook, Amazon, Apple,
Microsoft,
Alphabet,
Google?
And Microsoft and Alphabet. Google's parent.
Google, yeah. They have very different approaches too, from what I've been writing about to the market. Apple is notoriously isolationist in a good way.
Yes.
I think.
Other questions? Please feel free to ask anything that comes to mind.
John, it's Connor. How you doing?
Hey, Connor, how are you?
Good. Curious, obviously, I'm still in the workforce. I think looking at the group here, maybe, more of the exception than the rule here, but what are the key indicators that you're looking at in terms of, if we are headed into that mild recession that you talked about?
So I alluded to this a little bit in the beginning when I was talking about the weighing machine and the voting machine. And one of the concerns that we are always going to avoid is trying to make short-term decisions for short-term outcomes. And our objective is always going to be focused on a little bit longer term, because what we know is taking action on the short term with the short term in mind, we're forced to make two very impossible decisions: when to get out of an asset class and when to get into an asset class. That's very, very difficult to do well consistently. So we're going to continue to focus on high quality companies with the mindset of protecting that 2-year and shorter spending need. that 2-year and shorter spending need is what's extremely important for us to constantly be keeping an eye on, so that we can direct the portfolio to be able to support that with minimal volatility or no volatility is the goal.
Great, thanks.
Please keep soldiering on through this time, John. We all need you.
Thank you.
So we have, I think, more political risk in the world today than we've had certainly in decades. China, Taiwan, North Korea, Ukraine, high inflation in certain countries. As you try to structure our portfolios, how do you talk, can you discuss, I guess, how do you deal with that?
Sure.
If at all? And
Yeah,
that's question one, but part of my next question is going to go to, given the conflict in the world, given the fact that our country creates one of the best weapons in the world, is it wise to try to invest in the defense industrial complex because of the need for countries all over the world to try to arm themselves?
So let's start with the latter first. I've read some journalists feel that we might be falling behind in the quality of our, I guess you'll say, our arms or our the technology in our defense systems to several countries, right? China in particular. We have not, other than times of initial war, overweighted to defense. Times of initial war, you oftentimes do see the defense sector take off. And there are times in between, certainly the defense sector takes off, but we're still a little bit cautious about overweighting there because that can change in a moment's notice based on what happens politically. And then going to the geopolitical, to be honest with you, that's a very difficult ground to navigate. However, with the Russian invasion of Ukraine, we immediately researched our exposure to both Russian equity and Russian bonds. And the good news was we had pretty much zero exposure. We had zero exposure on the bond side, and we had a fraction of 1% on the equity side for all clients in terms of any exposure. We're pretty pleased with that. But if that weren't the case, then we would have narrowed that down to where that exposure was and probably taken some action. I hesitate to get in depth with regards to the concerns of China, Taiwan, U.S. I'm hopeful that things resolve there, but if they don't, then it is most likely only going to make sense for us to go substantially defensive in most portfolios. And that's a conversation we'll need to have with each of you as to what your comfort level is based on how significant that concern ultimately becomes. But I won't put lipstick on a pig. That's a little bit concerning in terms of what's going on there.
Again, John, great presentation this month. Thank you very much for everything.
Thank you, Jim.
Hey, John, Chris, want to congratulate you on the 25 years you alluded to earlier. And
Thank you.
as the last comment said, you show your knowledge quarter after quarter, year after year. And since I've known you for almost all those 25 years, your integrity and genuine interest in your clients is, I'm sure, why you and the team members that you assemble have led to those results over that time. So congratulations, friend.
Thank you. Appreciate it very much.
We ditto what Chris said. Thank you, John.
Thank you, John.
Thank you. All right, we'll just give a couple more moments for anybody who, again, has any comments or thoughts or questions. Dee, I see your mind spinning there.
So did ChatGPT prepare your presentation, John?
Did I talk about ChatGPT in the last quarterly? I can't remember. Did I mention ChatGPT in our last quarterly?
No.
No. I don't know how many of you are familiar with ChatGPT, but that will be dinner table verbiage in the very near future for everybody. It is going to dramatically change our lives. We have been working pretty diligently to find ways to realistically invest in ChatGPT, but it's kind of hard without taking substantial exposure to positions like a Microsoft, right? That are historically overvalued. So just briefly, ChatGPT is a form of AI, artificial intelligence. And if you go on your phone or on your computer and you just Google ChatGPT and you go to, let's say, the OpenAI version of that, you can type in almost anything you could imagine. So the first time I tested this was back in December, and I asked for a summary of the Secure Act 2.0, which was new legislation that was signed on December 29th, 2022. And I gave it certain parameters, right? From a financial advisor's perspective, presenting to a client, I put in there. It produced an 11-page summary. And I'm pretty familiar with that Secure Act 2.0, so it was neat to read through that. And it was actually incredibly accurate.
Wow.
Now, that is not always the case. I have a good friend who's a surgeon, and he's used it in his profession to help him he does eye surgery, and he used it to help him make certain decisions on product. And what he found was he studied it a lot, and then he used ChatGPT to create a report for him to help him determine what he wanted to do. They referenced some of the articles that he had previously read, but inaccurately showing it supporting one argument over another when the article never did such a thing. So you do have to be very, very careful about that output, and just recognize that it's not always 100% legitimate. Now that will get better and better over time. This is only, what, 6 months old? 6 months old? Yeah, I think ChatGPT's only been around for about 6 months. But it will substantially impact many professions, from real estate agent, attorney who drafts, contracts, things of that nature. You can go on there now and ask it to create a real estate transaction contract in the state of New York. It is pretty darn good. I've looked at it and compared it to what an attorney produced. It's very good.
I was just going to say, one person that I write for said something about ChatGPT that I thought was really interesting, which is that the biggest business risk with it is that it never says, I don't know.
Yeah.
Seriously. I mean, like the overconfidence of it, it presents itself as being, factual, when in reality, it may be 96 or 97% accurate, but there's a risk.
And Maria, you may recall this, but that just sounds like the typical 14-year-old. No.
It sure does. Or 3-year-old.
Yeah, my 14-year-old was, yeah, I know, Dad. I know. I never hear, I don't know.
Just a question you mentioned in your presentation about banks now, some banks.
I thought you were going to bring up attorneys for sure.
No. Certain banks, saving accounts now offering, much higher rates than we've seen before, 3-4%. But then the larger banks like Chase or Bank of America, they're not doing that. They're still quite low. Those banks that are offering it, has that changed, your thinking or strategy at all in the short term? Or is that's just a blip on the radar that doesn't really change anything of the way you think?
So anytime that a bank is paying substantially more than its peers, I do think it's reason for caution, for concern. And that's actually what you saw with SVB, with Silicon Valley Bank. They were paying more than everybody else, so they had to go out and chase the yields so that they could offset that and make a profit. And they bought long-term bonds, and then those bonds went upside down, and then people started asking for money. I can get into the depths of that. In today's market, it is very interesting. The majority of banks are still paying about 10% of what the rate really should be, in my opinion. And they're catching up on profit. They're making profit. Some banks, when I'm saying that, I'm referring to checking accounts and savings accounts. Some banks are offering attractive money markets and or CDs. I can't see putting money into a CD in this environment because you got to lock the money up. It's not giving you anything better than we're using the Fidelity 3-month Treasury. Most of the CDs are paying you less than that. And with the Fidelity 3-month Treasury, you don't have to lock it up. I'm not too concerned about that. I don't see there being huge consolidation in the banking industry. I don't think there's any doubt that we're going to see new banking regulations as a result of what we experienced. And they're probably going to end up having the regionals just match the same regulatory requirements of the big banks. For those of you who don't know, in 08, 09, what came about there was significant new regulations but the lobbyists for the regional banks won out and they didn't get the same regulatory requirements as the big banks who failed us in 08, 09. So all these years, the big banks have operated under different rules and regs than the regionals. And now it's sneaking up to bite us in the behind because the regionals, some of them took too much risk with their underlying investments. By the way, to my knowledge, my understanding, we are the only country, developed country, whose banks are regulated differently. Other developed countries, their banks are all regulated the same. Let me say that a little bit differently so I'm clear. No matter the size of the bank in Germany or France or wherever, they're all regulated the same in that country. In the US, we regulate large banks different than regionals. It makes no sense. All right, with that, I'm gonna take us to a close. And again, just thank you for taking some time out of your afternoon. And I apologize that again, we have to write these in advance and get them approved. And I can't deviate much from script. I did get my hand slapped because last commentary, I did deviate from script a little more than I should have. But thank you for recognizing that this is all pre-written and that I have to read from it. You all know that I much prefer to have those open conversations and dialogues as opposed to reading from the script. Thanks for your time. Thanks for your attention. Thank you for the opportunity to let us work with you and your families, and be safe. Have a great rest of your Monday.